Good evening and welcome to the second session of our winter term money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I am Damian Pudner, Director of the IIMR, and today we are very fortunate to be hosting Lawrence Goodman. Lawrence is the president and founder of the Center for Financial Stability, an independent, non-partisan think tank focused on global finance and markets. During his career, Lawrence has advised institutional investors, hedge funds, and governments, and led research teams on Wall Street and at the US Treasury. These include as Global Head of Emerging Market Strategy at Bank of America, Head of Quantitative Policy Analysis at the US Treasury, Chief Global Economist at Santander Investment, and Head of Economic Research for Latin America at Salomon Brothers. He is a member of the Financial Research Advisory Committee at the US Treasury's Office of Financial Research. He is also a member of the advisory board of the Penn Institute for Economic Research and formerly a member of the Export-Import Bank of the United States Advisory Committee. We are also joined tonight by Professor Tim Congdon, founder and chair of the IIMR. Tim is one of the world's leading monetary economists and arguably the UK's leading exponent of the monetarist school of thought. He has advised the UK's Conservative government on economic policy, serving as a member of the Treasury panel of independent forecasters, the so-called wise men, for 5 years from 1992 to 1997, which advised the Chancellor on economic policy. In addition to his career as an economist, he is a successful businessman, investor, and writer, producing academic papers and other works on money, banking, and the wider economy.
Thanks very much, Damian. Good afternoon. The Silicon Valley bank crisis provides yet another clear example of why the conduct of US monetary policy is in need of reassessment. Much has already been written about the Silicon Valley Bank. For instance, concentrated exposures, a poor understanding of portfolio companies' business dynamics, and a failure to anticipate the impact of monetary policy on swings in the bond market. All of these contributed to sinking the bank. The bottom line is that a better risk management system may have prevented the crisis at Silicon Valley Bank. Here, Bill Rhodes's Banker to the World would have been a good place for the board and management to start. Today, I'm not going to follow this path. We will undoubtedly learn much more in coming days. Rather, I will illustrate how volatility at the Silicon Valley crisis, at the Silicon Valley Bank, and how this impacts monetary policy in particular, and in particular to the problem at this institution. But more importantly, I will highlight crucial lessons learned since the 2008 financial crisis. We have in part been here before. Ideas presented in Charles Kindleberger's Manias, Panics, and Crashes, first published in 1978, are essential for investors to profit and officials to design better policies. Even though the book is now in its 8th edition with insightful expansion by Bob Aliber and Bob McCauley, I'm surprised that it has yet to be more actively embraced by official institutions. Of relevance for today, right now, Kindleberger, a Keynesian, wrote, "Speculative manias gather speed through the expansion of money and credit, or perhaps, in some cases, get started because of an initial expansion in money and credit." In other words, integration of money and credit measures into the policy framework can be exceedingly helpful. Today, the banking system is even more complex in an era of rapid technological progress. The failure of Silicon Valley Bank highlights how rapid communication can hasten bank runs. Similarly, financial flexibility afforded by technology has also led to a proliferation of new non-bank liabilities in the financial system. Hence, it is essential to measure the transmission from Fed policy through this increasingly complex and technologically driven financial system into the real economy. To illustrate these points, I'm going to pose 3 questions. Answers to those questions, at least to me, are essential to help guide future thinking about policy implementation. I will answer these questions, but I would also like to use these questions as a springboard to solicit your perspective at the end of my presentation. I will also finish with a case study of how we at the Center for Financial Stability used these money metrics in real time to understand markets, the economy, and policy. Advances in monetary measurement. At CFS, as I mentioned, we've learned much over the last 10 plus years by producing and delivering monetary and financial data to the public on a monthly basis. CFS data brings to life Professor Barnett's monetary and financial measures, which are rigorously grounded in economic aggregation and indexation number theory. Details can be found in Bill's book, Getting It Wrong, published by the MIT Press and the winner of the Best Economics Book of 2012, awarded by the American Association of Publishers. More details are also available on the CFS website in the Advances in Monetary and Financial Measurement section. As background, CFS Divizia aggregates are broad. They measure activity in banks as well as shadow banking institutions. They're also narrow. Second, Divizia is an index rather than a value in currency. The index is created by adjusting different types of financial liabilities by their moneyness or the service value that they provide to the real economy. For instance, the moneyness of a repurchase agreement transaction is much, much lower than a dollar bill. It's much easier to buy a cup of coffee with cash than a repo. So questions about thinking, helping us guide thinking and drawing on what we've learned from the Divizia monetary aggregates. First question, why does the Fed no longer even look at money? Many believe that monetary measures are useless because V or velocity is unstable. Yes, true, but our empirical work highlights tremendous informational content in M, or monetary aggregates, regardless of the variability of V. And also, the money demand function is stable rather than V. V is just an equilibrating variable. In our early days, Bill insisted that I meet with one of the premier Keynesian economists in the world, Mike Woodford at Columbia University, to simply explain what we're doing. I explained and then listened. He got it instantly. You're measuring the financial system, fantastic. He then pondered whether the new measures might be useful as an input to his nowcasting models for possible use in nominal GDP targeting. They are useful, and we've papers to prove this. A second reason that the Fed and many economists no longer look at money is a belief that monetary quantities will be pursued as a target by the Fed. The fear is that a monetary target would meaningfully reduce Fed discretion in policy in favor of data or an algorithm. These fears are not completely unfounded, as evidenced by the growth in Bitcoin and the blockchain monetary mechanism over the last 10 years. But here, I'm sympathetic with Charles Goodhart's law that warned in the 1970s that any target would ultimately be rendered useless. Charles was prophetic. After the quantity target helped successfully reduce inflation and restore central bank credibility in the early 1980s, this is indeed what happened. So the answer, to me at least, is clear and obvious. Use it, but don't target it. Don't throw out the baby with the bathwater, which is precisely what's happening now. Second question, how does Congress manage the Fed and evaluate its results and achievements? After all, corporations are constantly evaluated by their investors, their boards, and their shareholders based upon the quality of their deliverables and their results. Section 2A of the Federal Reserve Act is clear. It says, the Board of Governors of the Federal Reserve System and the Federal Open Market Committee shall maintain long-run growth of the monetary and credit aggregates commensurate with the economy's long-run potential to increase production so as to promote effectively the goals of maximum employment, here we go, maximum employment and stable prices, the dual mandate, and moderate long-term interest rates. Unfortunately, the Fed is almost solely focused on measures of employment and inflation. There has been an excessive and overly simplistic reliance on the dual mandate or the seesawing back and forth between these two poles. Why? The approach is easy to explain and absorb, but the world today is more complex. Hence, this has led to trouble. Yet Congress is very specific in saying the Fed needs to maintain long-run growth of its monetary and credit aggregates commensurate with the economy's long-run potential. Money is absent from the Fed's policy calculus, as well as its communication with market participants and the public more broadly. Worse, the Fed downgraded money by halting publication of its broadest monetary aggregate, which was M3 in 2006. The timing was terrible. The Fed's M3 included repurchase agreements, financing vehicles at the epicenter of the global financial crisis. And take a look at the figure on the screen. This was at the epicenter of the financial crisis in 2008. Hence, critical data were no longer available for the public or the Federal Reserve itself. And you can see the blue line is what the Fed provided. And then our calculation shows M3 in the red line, which accelerated in a nearly linear fashion between 2003 and 2008, from 5% to over 15% year on year. Warning lights were flashing. It's no wonder that the Fed missed the financial crisis. Third question, what is data dependence? Here I'm confused. In April 2021, a data dependent stance took 8 months for a reaction. Meanwhile, the word transitory continued to surface. In contrast, in January 2023, this year, it took the Fed a week to respond, which led to shockwaves throughout the Treasury curve and into other markets. This likely accentuated, didn't cause, but it likely accentuated the losses and slide in the Silicon Valley Bank. What I'd like to do is talk a little bit about how we use this data, present almost a case study. Those are the big picture issues, questions that I'd love to hear your feedback on, but also how we've used this and how we believe that based upon our experiences, CFS Divisia money can help inform public policy. The following case study shows how this data dependence and this almost retracement of monetary metrics in real time can actually help do a better job of this. Tyler Cowen frames the inflation and monetary dilemma perfectly. He stated in a Bloomberg piece, gosh, it was February of last year. He stated, but he hammered it, he nailed it. He states that, quote unquote, plenty of people like to say that they knew at the time that the big money supply increases of 2008 to 2009 were not going to lead to high inflation. There are also those people who like to say that they knew at the time that the combined monetary and fiscal response from the pandemic would lead to high rates of price inflation. Then he nails it. He says, but relatively few people can gloat about getting it right both times. We nailed it, but there is absolutely no reason to gloat. There is a critical need to examine evidence, learn from mistakes, and realize the use of money in the policy calculus would likely have led to different outcomes at critical points in time. Cowen is right. In 2010, a group of prominent economists wrote an opinion letter to then Chairman Bernanke, urging reconsideration of quantitative easing and other experimental monetary policies. The letter made many important points regarding the dangers of quantitative easing. However, an unfulfilled claim that planned asset, and this is a quote, planned asset purchases risk currency debasement and inflation, ultimately met with sharp criticisms and unfortunately diminished the impact of the economists' message. Quite simply, as you can see in the figure on the screen, quite simply, had CFS Divizia been part of the dashboard, these economists, the emphasis on inflation and in currency debasement might have been muted, or at a minimum, the threat may have been pushed into the future. At the time, CFS Divizia money was collapsing. It demonstrated a drop of 1.3% when that letter was released. The other piece that I'd like to show is the second phase of this is the rebirth of inflation after the COVID response. And the rebirth of inflation is clearly one of the critical issues today, and we're still living through much of this. I've broken it down into 5 phases. Phase 1, which I characterize as an unnecessary ease before COVID. Our data are very clear that between December 19th, 2018 and January 29th of 2020, there was an ease almost in reaction to the Fed meeting in late January. And that's a whole other topic, but our data show that the Fed pursued an easy stance that put us in an awkward position at the outbreak of COVID. Second phase, here there was clearly a needed policy response and a strong response at that. But so we almost call this needed policy response, but signs of inflation. And then I'll run through the 4 phases, but the next figure shows how and why during this period that we had data suggesting that inflation was going to be a key factor. And during this period, we wrote a piece literally with the distribution of this data in April 2020, where disinflation was going to quickly become inflation. And others have as well, but the data certainly helped us. The data can also help the Fed. The next phase, phase 3, is what I would characterize as warning lights. This is just before inflation really took off, or as inflation was starting to increase. And this phase I'd call warning lights and transitory. So what I pictured here is what we communicated at the beginning, that there would be essentially a transitory issue. Our data, both on a year-on-year basis and a month-on-month basis, said we were still clipping along at far too fast a pace, that something needed to be done. But it wasn't only our monetary data, but in April of 2021, the top measures of prices exceeded the Fed's target by a full 1 percentage point. So there was a clear need to think strategically about any change. The next phase, which is a very positive phase, is the period between the aftermath, between this at the beginning of 2021 through the end of 2021 and into January. This I like to think about as monetary policy is just right. And you can see in this chart where during that period, and this is a month-on-month perspective of how our Divizia aggregates were moving forward, they were below the average threshold, but above the zero line. So policy was clearly being tightened and necessarily tightened, but not overly tightened. So the final phase, phase 5, is this period where we would believe that there's been an over-tightening. And you can see from some of the measures here, and this chart is from a piece that we released called Falling Money. We released it in early 2023, Falling Money, suggesting how the latest data that we had for January was showing an actual contraction, and not only a contraction, but a contraction in money even more than what happened in the aftermath of October 6, 1979, when the Fed started targeting reserves. So here we had a clear sign of over-tightening. The last slide that I'd like to share with you also breaks down some components. Okay, so we've talked a lot about the big picture, but here, as part of that falling money piece released in January, released on the heels of the January data, what we found clearly is that deposits were being destroyed. So deposits in the financial system in the United States were not only being destroyed, which is a clear signal that deposit growth was either shifting or on a net basis being destroyed. So certainly it was shifting into higher yielding liabilities, higher yielding accounts, which clearly was an early warning sign with respect to the Silicon Valley Bank, and whether the authorities thought about it from this perspective, that's a different issue. But clearly this could have been one of the breadcrumbs to more deeply investigate what was happening through the financial system. But it also shows, and when we do an analysis overall, it shows that net, not only is there this transfer of deposits into other liabilities such as money markets, but there's been an actual destruction of money, which is causing some of these complications. So when the payroll employment numbers hit for January, as well as the CPI data and the retail sales data, it was clear that the data were at odds with what the signal that money was sending. So it raised a lot of questions. And we found out, number one, that this January was the 6th warmest January that we've experienced in the United States since 1895. This clearly had an impact on the data that was reported. And then I can go on and on about owner's equivalent rent and the change in the retail picture. But suffice it to say, even if you didn't believe the money numbers, at least it could have served as a vehicle to raise questions. So wrapping that up, and I can go on and on about these cases, but in conclusion, there really is no reason to gloat. There's a reason to see that money does matter. The inclusion of CFS divisia aggregates or some other measures that look at the same idea is important. And having possibly used those aggregates in the past, it may have altered the trajectory of financial markets, and more importantly, the real economy. If not the Fed, then Congress must insist on the inclusion of monetary and credit aggregates and also as a live input into policy. The last comment is, please use our data. It's available free of charge on a monthly basis. Would love to hear how other people are thinking about this. I really just wanted to share our perspective and what we learned and how it has influenced our thinking with very specific issues that have evolved over the last several years. So Damian, Tim, thank you very much.
Well, thank you, Larry, for such an engaging and insightful opening presentation on such an important and timely subject. Tim, would you like to add any thoughts on that so far?
And first, we just thank Larry very much for a great presentation. We're very much on the same wavelength in believing that quantities of money need to be introduced back into monetary policy. It's been, in a sense, my life's work arguing for this. So we also agree, I think, that it's broad money that matters. In essence, it's bank deposits, really. We may have some differences about divisia against simple sum aggregates. I prefer simple sum aggregates because I know what's driving them, and I can tell stories about how bank deposits affect the economy. And I find using divisia complicates matters, but we agree about the importance of bringing money back into. Can I quickly say something about Milton Friedman in this context? I think his work remains fundamental. In New York, in 1959, he gave some lectures, the Miller Lectures, which is where he recommended in the USA there should be stable growth of money at a low rate. He said about 4%, and that was intended to deliver price stability. Trend rate of growth real output 3% of that time, higher than today, and he expected money to rise about 1% a year more than normal GDP. Can I just say that in the, what is it now, something like 60 or so years since then, that money has indeed risen almost exactly by 1% more than nominal GDP, and in that sense, Friedman's conjecture was brilliantly right. We did actually have in the 2010s a period when the Federal Reserve wasn't explicit to doing this. They didn't even notice the money numbers, but what actually came out was quite a long period of about 8 or 9 years in which money growth in the USA and the UK and in the Eurozone was around about 4% a year. What did we have? We had on-target inflation, stable growth of output. It wasn't a booming period, but a stable period. To me, this confirms that Friedman was basically right. What we've had is what we call a great stabilization, as you wish. And then we had the reaction to COVID. Money growth in the US reached at one point 26%, the highest figure since 1943, since the Second World War. Larry, you and I, seeing those numbers, you were looking somewhat different way from me, but saw those numbers, we both agreed inflation had to follow. The economic profession was talking about disinflation for some years. Larry and I were right, and we can close if you wish. The sad thing is that we remain very much by ourselves. We're still outliers in the profession, and we have a good model which basically works. Now we've got money growth, having been at 26% in June 2020. It's now perhaps since the figure is the growth last year is, well, in fact, there's no growth. Quantity of money has actually fallen. This kind of instability in money growth will lead to instability in demand, output, employment, and I'm afraid also in inflation. And so, if you like, going into great destabilization. We want to get back to stable growth of money. And I think that Larry and I very much agree about that. In that sense, we're very much on the same side.
We have a quick question from an audience member here. Would a divisia money aggregate be useful as a target for a Friedman-style monetary growth rule? And if so, how might that work in practice, given the different and changing weights of various monetary assets?
That's an excellent question. It could be used as a target. And in fact, it's an index rather than an observable portion. So it literally can be used as a target. Our recommendation would be not to target it based upon its variability. And most importantly, which we will probably get into more, is related to the leads and lags of monetary policy. So the lead and lag of monetary policy ultimately into the economy. Our empirical work suggests that today, it's just under what Milton Friedman thought. It's anywhere between 9 and 18 months that what's happening now will more actively influence the economy in a 9 to 18 month period of time.
Thank you. What does the decline in divisia mean for US disinflation this year and deflation next year?
Our view is that we are experiencing a period of disinflation. And clearly the response to the data in the last few months continues to underscore that notion. We were extremely surprised to see the response to a CPI inflation rate that fell year on year from 6.5 to 6.4%. There became this fear that all of a sudden inflation is heading in the wrong direction. When you strip out the owner's equivalent rent from that, and you neutralize or normalize that owner's equivalent rent, you would have been down at a print of around 6.1, 6.2%. So the same is likely true for this month's release. And that will continue into the late spring, when by the middle of the year, we're likely to see US inflation below 3%. So our view is disinflation will continue.
Okay. Do you have a year-end target for US inflation at this point from your models?
We've done some work on this. Our expectation is that it will be tough to get it back down to 2.5%, but our models are putting it at around 2.5% by the end of the year.
Okay.
So inflation clearly, and these models, the output obviously changes a lot because they jump around, but they change in a pretty consistent way, and they've been pretty consistent at below 3% mid-year and about 2.5% by the end of this year. So that was another reason why we were stunned, absolutely stunned, by not only the Fed's reaction to the January data, but also the market's reaction. I mean, look at what happened on the 2-year sector of the curve and the 10-year sector. It's really extraordinary. So yes, we do have those forecasts. They've been our longstanding forecasts, and we're sticking to them. Could
a divisia money aggregate be constructed individually for each of the 3 sectors of the non-bank private sector, i.e. households, non-financial companies, and non-bank financial institutions? Yes, it could. It's really an issue of the data. There certainly would be available the data through those categories. It would really be a data finding exercise, but based upon my knowledge, I would know where to look. It might be a little bit of a hodgepodge, but certainly that data would exist. The only fear that I can initially think of right now is that it might be quarterly data, given the importance of understanding the ebbs and flows of central banking and the influence of central bank activities, how they ricochet through the financial world, both institutions and markets, and then into the real economy. We need as real-time a measure as possible. But yes, we could certainly look at a divisia measure and create a divisia measure on a less high frequency basis. Okay.
Damian, can I come in?
Of course.
Okay. The quarterly flow of funds data from the Fed would have the numbers on time deposits, on currency held by different sectors. You could do it. There's weekly data on bank deposits. So late March 2020, you could look, late Friday night in our case over here in the UK, you could look at the weekly H8 release from the Federal Reserve. You could see what the FOMC was saying and what Jay Powell was saying. you could see through late March, early April, on a weekly basis, you could see what they were doing was going to cause an explosion of money growth. Even then, we forecast there's going to be an inflation problem in the US. You know, that's late March, early April 2020. It's all down in, you know, Center Especially Evaluation Institute and so on. The stories I tell about the economy, yeah, the sectors are very important. And I'm really concerned about basically the deposits they hold, right? You're running a business, you're looking every week, certainly, you know, every day sometimes, what's happening to your bank balance, okay? You know, if you're told your bank manager you're going to be 3 months' time, your bank balance is up by 5% and it's down by 20%, you get a phone call from the bank manager, what's gone wrong? You've got to start doing things. Running a portfolio, you've got to balance your cash against your equities. Your cash rises rapidly, you put it in the market. If all the fund managers doing it, equities rise. So this is really, it's real world. And I prefer to look at simple sum money, not Divisio. But look, we agree about the need to look at money, and that's, you know, that takes us forward. And I do wish the Federal Reserve would listen to us.
Thank you.
Just adding on to that, I agree with you, Tim. I'm a very practical person. And at this stage, we need to be practical about how we contemplate the responsiveness of markets in the economy, rather than simply ideas that are unproven. We need to be empirically driven these days. And that's why this issue of data dependence is so important. So I share, Tim, your practicality. And again, we can discuss the merits of Divisio. And I do realize that there's this added layer of complexity. There is certainly an added dimension of complexity to Divisio. But in my studying it and working closely with Bill Barnett on the construction of these aggregates, I can see, and even based upon the academic work that has supported this, you do get a more interesting read from Divisio because of the ability, this moneyness that I was talking about, the ability to transact, that all instruments, all monetary liabilities are not different. And that's why I also appreciate your reference to Milton Friedman. I think that when Milton Friedman wrote The History of Money in the early 1960s, he was talking about a broad aggregate, which was deposits. But my gosh, the financial system has changed demonstrably since then. And that's why our broad aggregates, I'm a huge fan of what Bill has done, because we've gone out and measured the shadow banking system. So, you know, in response to this question, can you create a Divisio aggregate for different measures, different monetary measures? The answer is a resounding yes, you can. And in fact, we did this during the financial crisis to look at the shadow banking system. So we had just a Divisio shadow banking system aggregate that we were following, because in the run-up to the 2008 crisis, the shadow banking system exploded. And that's what you really needed to look at to understand the evolution of markets before 2008 and after 2008. And that measure absolutely collapsed. And we were below a trend rate in the shadow banking system for a long time. And that's why we didn't have inflation from 2008 until meaningful inflation from 2008 until 2020, 2021. So yes, I share your, and I think that if Milton Friedman were looking at this today, he would also be a proponent of a different definition of broad money, which includes the shadow banking system.
Can I just say that I'm sure Larry and I agree about this, is that the Fed looks at the labor market. Okay, that's the way they please. The labor market lags the economy. Money leads the economy. And let's just think about that in this episode. You know, spring 2020, you could say, Friedman said there's the lag varies. But on average, it's kind of 2 years between money and inflation. First of all, it hits asset price, then it hits output, then it gets inflation. Wasn't Friedman right? We had the surge in money in spring, summer 2020, summer 2022. The central banks woke up and realized it wasn't transitory, it was a real problem. The labor market lags. You know, Larry and I may have discussions about divisor, simple sum, and so on and so forth. We are talking about things that lead the economy, not that lag it.
Thank you, Tim. Well, nicely following on from that, we're having a lot of questions come through on exactly that point on lags, long and variable lags, in relation to the overhang, monetary overhang that's being created by excess money printed by central banks over the last 18 months, 2 years. How long will it take to get rid of the overhang? Question one, given the leads and lags. The second question is, people want to know, will the Fed and other central banks put more focus on financial stability over their mandate to get inflation back to 2%?
Yeah, they're related but unrelated in a way. How long will it take central banks to get there? I think the Fed was already there. I think the Fed was clearly already there. We have a model that looks at interest rate pressure on central banks, and our estimate now is that the Fed is, if not there, very, very, very close to being there. So a lot of this has been extinguished. The other thing that we've done is we've looked at deposits, because a big part of what's been driving demand has been the sympathetic impact from the fiscal side on the monetary side. A lot of fiscal spending, a lot of liquidity in the banking system. So we've been looking at the stock of money that consumers have. And our estimate is that right about now, consumers are out of that stock. They've spent it. So that also is another way of looking at, has it been extinguished, yes or no? In contrast, you look at the ECB and the same position in the ECB, and the ECB is far behind the curve, whereas the Fed is right about at the curve and they've extinguished the problem. The ECB still has a long ways to go. Our estimates are at least 200 bips. And in terms of the interplay between financial stability and policy, that's going to be a central bank by central bank issue, and how each central bank responds will be up to them. But I think that the dynamic will also be an interesting one, and this argues for why monetary data are important. You really want to be consistent with where the market's at. And in April of 2021, the Fed was not consistent with where the market was at. And it took the Fed 18 months to realize where the market was at. And during that period of time, imbalances were huge. Imbalances were created that led to trouble. So depending upon, and that has relevance for today, because the central banks that have extinguished those imbalances are going to be in a much, much better position to make that decision, financial stability versus policy priorities. So I think it's really going to be a central bank by central bank debate and discussion where they stand on which side of the equation, financial stability versus central banking policy.
Okay, thank you. Larry, I want to ask you a question I asked our guest last week on the webinar, which was, Do you think, given everything that's happened since 2020, that policymakers will countenance more the monetarist regime or the inclusion of monetary aggregates into their models going forward? And if so, do you think that will be done implicitly or explicitly, or are they just going to ignore it and move on as usual?
Right. Naturally, I am hopeful that they will be included more actively into models. There was a wonderful piece in The Economist shortly after the 2008 crisis that suggested, I think it was called the New Model Army. And it was suggesting that econometric models would need to better specify quantities and the reaction function of finance into the economy. And since then, that has been going on in academic circles, which is fantastic. I'm hopeful that the work that is being done in academic circles winds its way into policy. And I can give you a couple of very concrete examples. When I was at Treasury way back when, our group was responsible for many things, but one of the things that we would do is we would run simulations of the global economy for a whole host of different reasons. And we would also use FERBUS with the Fed and their simulations regarding responsiveness of varying variables. And one of the things that we found, especially with one of the econometric models that our group was spinning, is that it was really hard to get anything interesting about the financial sector. So the gentleman who was responsible for those activities did a fantastic job, and he used to refer to it as torturing the model, because the model wasn't specified to incorporate the financial function and what happens in money and finance into the real economy. So yes, I am hopeful, and I think that, Damian, the more that we do these types of events and talk about these issues, and the more that it is just resoundingly clear that money matters, it is clearly the mapping. Money is the mapping between Fed action and the real economy. And without it, how are you going to map the monetary transmission mechanism? So I am optimistic that this time around, yes, they will be incorporated.
Thank you, Larry. I mean, of course, I am in total agreement with you on that, and I'm sure Tim is as well. We have a late question coming in. One useful characteristic of simple sum measures is how amenable they are to a credit counterparts analysis of the money supply, e.g., how changes in commercial bank loans to different sectors may affect the money supply. Is the Divisa aggregate open to this approach?
I'm not clear on what the approach is. The simple sum essentially aggregates. I mean, the Divisa can take almost any component as long as there's a complementary interest rate. The math behind Divisa is extremely flexible. So
Right.
almost any index can be created.
Okay.
So the answer to that question would be yes, depending upon, the key issue would be the data constraint. But if the data exists, there's no reason why varying different components can be mapped together, provided that there are interest rates and that there are quantity measures. You can create specific indexes. And this is precisely what we did with the shadow banking system. We wanted to zone in on one part of the financial system. So it's extraordinarily flexible.
The beauty of simple sum is it's basically the banking system balance sheet. You look at what's happening on the asset side of the balance sheet, tells you what's happening on the deposits, liability side of the balance sheet. March, April 2020, we could see the Fed was carrying out open market operations, purchasing assets on a certain scale. I don't get the exact figure, but adding, say, $1,000 billion to US money in, say, 3 weeks, something like that. That time, money stock was $20,000 billion, higher than that now, but about $20,000 billion, 5% on money. I forecast that in April in the US, in early April 2020. That is the beauty of simple sum analysis.
Thank you, Tim. Do you have any closing comments, either of you, before we wrap up for the evening?
We certainly are in agreement regarding the imperative of putting money on the dashboard of central banks, and not only on the dashboard, but as a live vehicle for the contemplation of policy. And I think that what we've learned is the importance of this in real time. And the case study to me has been particularly powerful. We have a lot more detail on this that we will ultimately roll out for our friends and members. So this has been an extremely fruitful discussion, and appreciate it.
Well, thank you, Larry, for being so generous.
It's on the dashboard, and trying to run an economy, a central bank, it's like driving a car without a speedometer. It's crazy.
Just before we go, I want to remind people to please keep an eye out on our website and social media platforms for information and details of our next presentation under our Spring Term Money Webinar series. And with that, thank you all and good night.